Hey team, Ben Nash from Pivot Wealth here, and today I'm chatting about market updates from the month of August last year. Just a bit of a download in terms of what's going on, what the opportunities are, and what you should be thinking about based on where the world is now. Clearly, a lot of disruption and changes have been happening, so yeah, a bit of stuff to cover, but. Before I jump into the content, guys, please do not rush out and make any life-changing decisions off the back of what I cover. I strongly suggest getting some personalized advice from someone with a magnificent beard before jumping in. So, team, firstly, yeah, lockdowns obviously continuing in Australia and around the world. We're seeing a big forecast for contraction in economic growth off the back of what's been happening in Australia in particular. It's expected to be pretty sharp with everyone sort of sheltered up in their COVID bunkers, where a couple of percent, I think, contraction, which is pretty significant. Although it's likely that growth over the entire year is still going to be pretty significant, but this quarter is pretty rocky. So fingers crossed, Gladys and the rest of the premiers can get us back on track to actually start spending some money and getting this economy sort of pumping. The property market as well, a lot of stuff happening in the property market, but it slowed down definitely in the last month, but still the growth has slowed, but it's still up 1.5% for August, which is pretty significant in ordinary times, but it's the slowest for some time with the rises that have been happening off the back of the COVID disruption as well. We are still seeing more potential for property prices to continue rising based on the fact that there's very, very limited supply, and in particular in blue chip areas. Not a lot of people moving. People are sort of staying put, and the supply is severely constrained. The people that do want to move, they really want to move, and that coupled with really low interest rates is putting some upwards pressure on property prices, and I think that's likely to continue. I'm going to circle it back on property in the opportunities section as well. Our unemployment rate at the moment in Australia, at least, is 4.6%, which is the lowest level since 2008, around the time of sort of GFC. But the data is not the entire picture in terms of unemployment, because we're now seeing the number of people looking for jobs has reduced, especially the people that are in the areas that have been fully locked down with COVID, that they just stopped sort of looking because they really can't. So while that number is a good one, the real data is not is showing that there is a bit of a softening in the labour market as well. Another thing that we're seeing, there's been a ton, and you guys might have seen some of this, but a ton of corporate activity, mergers and acquisitions, takeover terms. One of the big ones, Afterpay getting bought out by Square, or at least offered to be bought out by Square, $40 billion or something. It's pretty enormous, but we're seeing huge amounts. I think it was in the $1 trillion range or thereabouts of corporate activity, which is sort of good for investors and shows that there's still a lot of appetite for companies, and seeing that there's positive outlook out there for those companies, and therefore investors by default. In terms of markets and market movements, look, the Australian share market up 2.1% for the month, which is not bad. S&P 500, 3.04% up, which is pretty significant, and I think like 100% above the pandemic levels. NASDAQ's up 4%. That's the tech index over in the US, 4%. That's whopping for the month of August, although July was pretty soft. So, yeah, over that period, it's still strong, I think, in my view, and clearly showing that tech is taking over the world. The FTSE, which is basically the world index, is up 1.2%, and the crypto mega cap index for last month is up a nice little 24% for all the crypto investors out there. So clearly some serious growth happening in the digital asset space. In terms of economic data in Australia, where our cash rate is still ultra low, 0.1%, 1.1% economic growth. Our inflation is up at 3.8%, and I'm going to talk a bit about the US inflation rate as well, but 3.8% is higher, much higher than what the target is for the Reserve Bank, and it shows that people are spending money, which is sort of good for the economy, although it's actually a real challenge in the next little bit, because normally when the inflation rate starts going up, the Reserve Bank wants to constrain that, and how they do that is by increasing interest rates, but seems highly unlikely that they're going to do that in the short term because of all the disruption happening in markets. And that's actually, like, it's good that they're not going to put interest rates up for homeowners, but it's bad because we can't return to a sort of a normal economic setup. So I think that in particular is one to watch in the next little bit, because if things start getting too inflationary there, then we're going to have to, I don't know, they're going to have to change something, because we don't want to end up as a banana republic, as our good friend Mr. Keating would say. So the unemployment rate is also low, as I touched on, and employment growth is up. We're seeing for the higher skilled jobs, real difficulties for companies in hiring. I've been reading a lot about that. I know we're trying to hire at the moment. It's challenging to find people. There's a lot of competition out there, but there's also a lot of people that are being really and rightfully so, but really picky with the jobs that they're taking, and knowing that they really need to consider their decisions based on all the ongoing COVID disruption. Off the back of that, we're seeing 1.5% wage growth, which is sort of cool. Good to see that going up, because what happens when that wage growth goes up is that it's supportive of people, one, being able to afford properties, but two, it allows all investments and markets to grow as well, because people can afford stuff. So when we're seeing that going up, that's a really positive thing in my view. We're seeing a lot, the savings rate is way up, where 11.6% of income is the average savings rate for Aussie households, which is well above the pre-pandemic levels, and sort of shows that people have recognized the importance of saving, and saving well, given the economic uncertainty out there as well, which is, I think, is a positive thing. We're probably under saving before. Look, from the US, and the US is important to talk about because they do have such a big impact on the Australian markets and markets across the world. But in terms of going back to that inflation number that I mentioned in Australia, that it's starting to sort of cool down. In the US, they had a strong inflationary data off the back of the pandemic, but that's now starting to come back, which is good. The economic output, or like the growth of the economy, the growth in economic activity, has returned to before the levels that it was at before the COVID pandemic. And that's sort of, those are a bunch of words, but before the pandemic, the economy was really humming along over there. So the fact that it's gone back to that is really positive, I think, for investment market outlook moving forward. Where and the other thing that's important to note with the US is that the bond yield for their treasury bonds, so their government bonds, was 1.3%, which is actually down from what it was in May. And that's might seem a little bit, well, it is a little bit complex, a little bit confusing, but the fact that the interest rates are going down there still on their government bonds suggests that we're not going to be getting interest rate rises probably in the short term if the economy stays in lockstep, which is, something that has happened in the past. And I suppose some, a bit of pressure relief for homeowners and not having to stress about interest rates going up. Our investment story of the month, or share story of the month, is Sydney Airport, which has been subject to a takeover bid from this consortium of investors led by IFM, which you probably haven't heard of, but it's an infrastructure management fund, which is part of the Q Super, which is now, with their merger with Sun Super, one of the biggest super funds in Australia. That's a $20 billion takeover offer. And it sort of ties back with that level of corporate activity that I mentioned, where we're seeing that these companies are ready to put billions and billions of dollars on the line, backing the performance of companies over time, which I think should give investors a lot of confidence. The Sydney Airport, interestingly, they actually rejected that bid, saying that it undervalues their company. So that tells me that they're even more confident in their outlook moving forward as well. Our money hack of the month from last last month, and it's based on what's happening right now in the economy and markets, is investing with your property equity. Now, the property market has run considerably. I spoke about this last month, and some of the stats in different suburbs we're seeing, 20, 30, even 35% in some suburbs for the property price growth. And if you own property pre-pandemic and have benefited from that growth, it's likely that you've got a bunch of new equity in your property. So basically, when your mortgage debt levels stay the same, but the value increases, the difference between that number is equity. And you can then use that equity to, do other stuff. Buy yourself a nice flat screen TV, or if you want to actually make some money, you can use it to use it as a property deposit to go buy an investment property, use it to buy a new home, use it to invest into the share market. And because interest rates are ultra low, 3%-ish comparison, there's even lower numbers that they put on the bus shelters and stuff. But because you can borrow at a really cheap rate, and the expected return on other sorts of investments like shares and property is significantly more than that 2 or 3%, you're well placed to really leverage that equity to accelerate how quickly you're building your assets. And I think I touched on last month the fact that it's these downturns that really make millionaires and set people up. So if that's you and you're in that position, think about, what is your plan around that equity? Are you putting it to good use? Of course, you need to make sure that you're really careful with your planning and you're not going to leave yourself exposed or just borrowing money, for the sake of it and not taking into consideration the risk management side of things. But for the right person in the right position, it's a real opportunity as we see it. So understand what your position is, how it can fit together, and whether it's something that should be on your radar as well. Our client issue of the month was come from one client in particular, although we've spoken to a few people in this position in the last little bit, that's worked for a tech company, had no plan around their tech company shares, and it just sort of plodded along for the last few years. They benefited in their company that, along with a lot of tech companies, has risen, with the share price has risen significantly over that time. But when we got diving into their plan, we realized that they had this huge capital gain that was sitting there on paper, and it went on so far that it got to the point that the tax bill that they were going to have to pay to realize this gain and actually use that money for their other personal wealth and asset building was so significant. It was a real psychological barrier, and they were really sort of in this stuck position where they wanted to do stuff, but they didn't want to suck up the capital gain. It was really limiting their options and the things that they could do. And, tech companies in particular, they reinvest a lot of their profits and cash flow back into the company, which means that you don't really get income in the form of dividends. So while it looked really good on paper, this asset that they had just sort of sitting in the corner, really not doing a lot, other than sort of plodding along, wasn't something that they could bring in to hit their other lifestyle goals that were actually really important to them. Getting that dream home, the other sort of passive diversified income, and reducing that dependence on having to work in order to cover your living expenses. So when you're in that position, I think it can be a really stressful wave, and you're facing a bunch of risk, whether you're aware of it or not. And ultimately, the worst case is that if the market does tank, and we are seeing a bit more economic risk out there at the moment, you go from millionaires to a thousandaire, and that's not a good position to be in. And I think the thought of that being there is something that is much more stressful than you should when you're in that position. So it goes back, I think, to the importance of knowing what your strategy is, understanding the options, and being smart and diligent from early on in the journey, or as soon as you become aware that there's an issue or opportunity with your tech shares, so that you've got a clear plan and you make sure that whatever it is that you're doing fits in with the bigger picture that you want for yourself and for your family. Our success story of the month from last month, we have been talking to a bunch of clients actually that have been coming through, rolling through for their review, their annual sort of refresh of their plan that reached out to us. It's sort of now, being September, they reached out to us when the dust settled around the initial COVID lockdown. They did some investments, bought some property shares, whatever, and now they've got the benefits of that. They've got the fruits of their investments. Look, most of them were really stressing at the time because it was a stressful time for investors, but the conversations that I've been having reminded me that these people have stuck to their plan. They knew what they needed to do. They blocked out that psychology. They utilized a good framework to give them confidence to make decisions, even when everybody else was panic buying and freaking out and not wanting to invest. And as a result, they've benefited, in significantly from a financial perspective as a result of implementing those changes. So goes to say, don't just follow the pack. Make sure you're using a good framework, and don't be afraid to be a bit contrarian if you're dotting your I's and crossing your T's. Our book of the month from last month, and this is a new one based on some feedback that I got from people that I thought I'd incorporate into this update, is the book that I've got is Will It Make the Boat Go Faster, by a guy called Ben Hunt Davis and a lady called Harriet Beveridge. It's a good book that talks about focusing on the most important things. But one of the things that stuck with me from this one is that they talk about goal setting in 4 layers, being the crazy, which is like, what's your big picture amazing goal? Then wind that back to what the concrete goal is, to say, okay, so it might be, being financially free, but the concrete goal off the back of that is getting $10,000 a month in passive income from your investment portfolio. Then there's another level, which is the control layer, or the things that you can control and the things that you can't. So if you take that same example, the things that you can control is how much you're contributing to your investment account. The things that you can't control is what's happening with markets. And then you've got your everyday layer, which is the habits, the behaviors that will drive your success in this area. So hitting those savings numbers, not buying in too much to the hype that's out there and the noise. This stuff is really similar to your money. The story was actually about an Olympic gold medalist, but you can apply it directly to your approach to money. And the other key message from this book was keep your focus on a maximum of 3 priorities. Otherwise, you end up with no priorities. So check that one out. It's called Will It Make the Boat Go Faster? Really pretty easy read as well. What we're working on at Pivot, we just wrapped up our August birthday celebrations. That was our 6th birthday. I'm pretty stoked about that. Through those celebrations, what we did is we raised money through our introductory one-on-one breakthrough sessions and donated that to charity. We had a target of having 60,000 positive impacts around the world through our partnership with B1G1, or Buy One Give One. We actually smashed that goal and ended up through the support of the community, the Pivot community and clients, which was amazing. We ended up hitting 1.3 million impacts, which is basically providing 1.3 million days worth of clean life-saving water to families across Asia. So really stoked with that. Another update from Aaron, we've just got our draft financial services license. That's been a big project that we've been working on for a while, and we're just in the process of making that transition, which is all going to be happening this month. Stay tuned next month. I'll give you an update on the joys of that paperwork. Also, rolling out our new services, which I touched on last week. We're off a bunch of feedback from people following along. Been getting some really positive feedback from that. So you can check that out on our YouTube if you want more information on how that works. And we've just kicked off a dozen online events. Jump on the Pivot Wealth mailing list if you're not already on there, and check out all the details there. Guys, I hope you found that one helpful. If you have any mates, friends, family that you think would get benefit from this content, please tag them in, give it a share. Cheers, team. Hope you enjoyed that. I'll catch you next month. Bye.